Hi, and welcome to the Intentional Wealth Update from Morton Brown Family Wealth for the week of March 14th, 2022. I'm Dennis Morton here with Cody and Katie Brown. How are you guys?
Good.
Doing well.
How are you?
Good. We've got a lot to cover here today, guys. We always prep for these sessions and spend some time bantering about ideas. And we just talked for a while across a lot of things that have crossed our desk and ideas that have kind of got us thinking a little bit with the market volatility and all the things happening in the world. I want to start just by a reminder of why we do these updates. It's really not to recap what's been up, what's been down, what's working and what's not. It's really to keep the conversation focused on the kinds of decisions that investors can make to keep their financial plans intact and really stay focused on the things they can control. Because volatility will happen. The catalyst is always different. Katie, what are your thoughts on how we keep people focused at these times on the things that really matter?
During these times, it really is the focus on the individual goals, the long-term efforts, and what they're trying to achieve, and putting things into perspective. So building the context around everything that's going on, but then also providing the space to really listen to the fears and the concerns that our clients may be feeling at this time, because there are so many headlines and we see so much activity around us every single day, and the ripple effects of that in pockets of the market, but then also the larger market as a whole. It creates just a lot of thoughts and feelings. And so taking the time to kind of listen to those and help build that context for our clients is really a lot of our job and what we enjoy doing.
Yeah, I mean, the truth is multiple things can be true at the same time. The stock market can be down, interest rates can be going up, and you can be fine. The plan can still be intact. That's why we have these conversations to try and keep that focus that you can still be fine, and here's how you can do it. So, Cody, let's touch base on a couple of different market trends. You found a couple of charts that are interesting. Let's start with just kind of where the stock market has pulled back, valuations. Where are we sitting right now?
Yeah, so it's been a tough market, not only in the U.S., but internationally for stocks so far year to date. But we were looking over it, and obviously there's a lot going on in the world for that volatility to happen. But we were looking at some of the valuations, and I know we spoke about it previously a couple times on some of our quarterly market updates, and then also in these videos, just how high some of the valuations have gotten inside the US over the past year or two. And so far, year to date, the most recent valuations that we've seen, they're around 20 to 30% off of the valuations that we saw from the high of last year. So while the stock market is not off 20, 30%, it is off around 10%. The earnings are still coming in strong, which is good to see. The valuations of the companies have just came down a little bit, which you could make the argument that it's time, if you can take on the risk, that it would be a good time to rebalance. But then obviously, as Katie said, we need to make sure we know our clients' goals and dive into all of that. But that was an interesting stat that we saw, that the valuations have came down. And it's not that the valuations have stayed the same and the earnings were weak. The earnings were strong so far year to date. It was just the valuations that have come down so far.
So it's that difference between the reality of a company's performance and the expectations. We've seen that, like the expectations for certain companies, whether it was electric vehicle makers or certain pandemic stocks, the expectations got way out over the skis of what the companies were actually doing. That's where there's that line that, a great company does not always mean it's a great stock. Those are two different conversations. But Katie, this is a consumer-driven economy. It was pre-pandemic. It is now. You found some information that also kind of belies the idea that there's recessionary activity because people have been ramping up their spending over the last 12 to 18 months.
Yeah. Cody posted this chart for us, really looking at personal savings rates versus personal spending versus U.S. household debt. And we can see in that top orange line there, the U.S. personal spending. We've talked about this before, starting back in 2019, and we're going to call that sort of the normalized line. And then we saw the immediate drop through the first part of the pandemic, and then the rapid climb. And it's continued to accelerate. So even coming out of coming out of last year, that acceleration has been fairly steep. That middle line there showing the U.S. debt that household debt has been climbing along with the spending rate, which often makes sense. But that's something that we're watching very closely because that has steepened more than previous, more than kind of the normalized levels going back. And at the same time, we see the savings rate it spiked at the beginning of the pandemic because everything shut down. So nobody was really spending money. And then we had some kind of intermediate spikes and drop offs as different variants came out, but that's trending down. And actually, it's down at near a 10-year low for the savings rate. The other interesting thing that we've talked about, though, is the relation to household wealth. And so, household wealth during this time has also increased, but the debt is increasing at a faster pace than the household wealth. We don't have the wealth line on here, but that has been increasing, and we've all kind of felt it and heard about it, home values increasing and otherwise. But we just want to make sure that we're paying attention and that there's not too much of a squeeze on the dollars that people have access to.
Yeah. And considering it's a consumer-driven economy, I think that's a big question: is how sustainable are those increasing debt levels? Cody, what was the article in CNBC a couple weeks ago about the number of households even now living paycheck to paycheck?
Yeah, with some of the higher inflation numbers that we've seen, obviously at the end of last year and so far year to date, that the average American, I think it was close to 64% are living paycheck to paycheck, which is up around 10% from last year.
Yeah, and even among high net worth earners, like $100,000 and above households, there's over 50% are living paycheck to paycheck. So it's a question of how sustainable is all of this. So there's some silver linings here, I think, that we've talked about. But what about things like Treasury yields? That's another question, Cody. We've seen an increase pretty rapidly here in the last couple of weeks. And what is the implication of that for investors?
Yeah. So today, Wednesday, March 16th, that the Fed's potentially going to start raising the rates today off zero. We'll see what happens there. But yeah, the Treasury rates have shot up on the shorter end and also the longer end. So the 2-year Treasury rate now is close to 1.9%. The 10-year has shot up to around 2.2%. So we've seen a drop off in the actual bond prices since we've had a rise in the interest rate. But it is good to see finally possibly getting some yield on the safer assets instead of getting all the return from stocks. So that is a good silver lining going forward. Right.
We want that to normalize, that the speed at which interest rates rise is a factor, but it's one of the reasons we talk about when you choose your bonds, how to make sure you're selecting the right balance so that you're not putting at risk on the way as rates go up, putting your principal at risk, and you can reinvest at those higher rates. Katie, another thing we talked about here was just how do you define real financial security? When the markets are declining by a good percentage, when stocks and bonds are down, people talk about, am I financially insecure because of this? But you've talked about the real relationship, which is between your income and your spending and how to reconcile those.
Yeah. I mean, ultimately, that's what's going to lead to your financial success is that relationship between your expenses and your income. And there are different pieces of each of those that are in your control and things that are outside of your control. In the short term, typically expenses are going to be more within your control. And so when we look at that spending chart and we see an acceleration there and also read, more Americans are living paycheck to paycheck, I think one of our pieces of advice would be kind of crack that open, pay attention to what you're spending. We've had conversations before around sometimes even things like subscriptions kind of get away from us, things that we might be spending money on that maybe we're not recognizing, or the things that we are recognizing and saying, okay, are there ways that we can kind of curb some of the spending if you are feeling concerned about kind of this environment, but then also looking at the income side and recognizing that a lot of this volatility that's happening in the market eventually will recover. And as the Federal Reserve increases rates, eventually there will be more yield, as Cody said. So that income piece that may be coming from investments, we think will normalize and grow over time. But if you're feeling a pinch now, taking a look at what you can control and what what's outside of your control and being okay with that.
Yeah, and it also speaks to the value of optimizing your income strategy. Like, how do you make sure that all of those decisions, if there's volatility, matter that much more? The right timing of Social Security, the right timing, how you're drawing down different portfolios, taxes, all of those things really come into play. Another thing, and this is going to be our last point for the day, is how can advisors coach their clients through times like this? And I think sometimes advisors are guilty of this and clients can be guilty of this, that we focus too much on what the markets are doing. That we spend too much time, that advisors get too much credit for the up markets and then do too much explaining on the way down. But it's really kind of shifting that focus and making sure that we're saying, acknowledging what happens, but then shifting over to the proactive side, right?
Right. This market environment too is a good place to be, or a good place to reflect and see, all right, what are things that I can do to be productive? How can I build in tax efficiency? When you start to get the volatility, that gives opportunities to kind of build in some tax efficiency, do some tax loss selling, make sure you're rebalancing appropriately, make sure you're in the right type of investments. And all of that leads back toward then reducing your expenses. So, I mean, those really do play kind of hand in hand.
Yeah, I'll never forget having a conversation. This was years ago. It was with a woman who's unfortunately widowed, and we were kind of working through conversations about finances and updating the plan. And one of her comments to me was, "Can we talk about the things that you and my husband used to talk about?" And I said, "You know what? In all honesty, I spent years trying to get your husband to stop talking about whether he bought Apple at the wrong time or not, or whether he should buy another speculative stock. It was the wrong conversation to have. The things that you and I are talking about right now are actually the really constructive things, and you should feel confident about that." And I think that's the good role that an advisor can play sometimes. All right, guys, we're coming up on March Madness. I haven't filled out my bracket yet. Katie, I know yours was filled out with Michigan State 6 months ago. So, but did you pick somebody new this year?
I haven't filled it out yet, but I plan on picking Michigan State. So yay, you got it. Nailed it.
Cody, how about you?
I haven't filled mine out either yet, but my favorite team is Kansas, since unfortunately Penn State is not good at basketball. So I will be picking Kansas to win it all.
All right, very good. I always love rooting for smaller schools here, so I tend to go for the Gonzagas of the world. So I think that's going to be my pick this year. I just love them for a while, but it should be a lot of fun. All right, well, if you have any questions for us, please feel free to reach out. We love doing these updates, and if there's something you'd like to hear us talk about, feel free to shoot us an email anytime. Wish you and your families the best, and we'll talk again soon.